day 3.
What's good, my people? Welcome back to the channel. It's day 3, episode 3 of teaching a dummy how to trade. This is a series where I take a complete beginner, being Sam, from absolutely no knowledge of the foreign exchange market to becoming a full-time, hopefully funded trader. So follow along. This episode 3. Today, we're going to be covering various concepts such as Fibonacci retracements. We're going to be getting deeper into key levels. We're going to be getting deeper into the actual approach to the market, starting to piece together some of the previous technicals we've been through, and looking a little bit further into some like risk management, some economic news and stuff of that nature. So let's get right into the video. Sam, have you got any questions from the previous session or from your back testing, the homework that you've done?
Not any currently. I mean, maybe one about setting correct key levels when shorting rather than going for a long position, but I'm sure you'll cover that when going into slightly more key levels. But yeah, hope everyone's doing good. Let's get this shit.
All right. Yes, sir. He cut out right there, but we caught the end of that anyway. All right, let's share the screen and we'll continue. All right, so between episode 2 and episode 3, which is today, I set you off on some back testing, some data collection on FX Replay. How did you find that? What was your experience like with that? Have you got anything you want to share with the people?
Yeah, so my main advice would be when going into backtesting, if you're completely new, like I am, is go through your first few backtests literally in a step-by-step fashion, following the last video where Daniel explained and broke down exactly how to do your first backtests. Because when first going into it, it can be a little bit overwhelming in a sense of there's a lot going on, etc. How to actually use FX Replay as well. So definitely just follow along step by step for your first back tests, and then slowly but surely you'll start understanding it. Yeah, that would be my main advice. And in terms of how it went for me, went well. Did quite a few. I think I'm up to around about 30 or so on a 40% win rate. But win rate doesn't matter, as Daniel has explained to me. It's just about collecting data, seeing what you was doing right, or well, more so what the market was doing at that time. So yeah.
Yeah, nice one. All right, cool. Let's get started right here on the first concept I'm going to be teaching you today, and that is the concept of Fibonacci retracements. Have you heard anything about Fibonacci? Are you familiar?
I might have heard it a little bit, bro. But to be honest with you, no, like these lines on the screen make no sense.
Cool. All right, so Fibonacci, for everyone at home and for you here, Sam, Fibonacci is a mathematical sequence where the previous 2 numbers add up to make a third number. So I'm not going to sit here and do all of the maths because it's completely irrelevant and no one actually cares. But you start on 1 and 2, and then 1 and 2 make 3. Then you go 2 and 3, 2 and 3 make 5, 3 and 5, so on and so forth. That's sort of the Fibonacci sequence. Again, it's long, it's mathematical, it's got a bunch of BS in here, and really and truly you don't need to know it. But that's the basis off of what we're looking at right here. This is mathematical equation. Now, this right here, and what you see, these lines, is the Fibonacci retracement tool on TradingView. So if you come here to the left of TradingView, it's literally the top one. It's called Fib retracement, and you can favorite it. You'll notice there's a bunch of other Fibonacci tools. You have Fib wedge, you have Fib spiral, circle, all of this other stuff. Honestly, I have no idea what all of this stuff does, but it's pretty apparent that Fibonacci is a major tool that a lot of traders use, and it has literally its own section. There's a reason behind that, because Fibonacci is one of the most widely used, popular, and profitable trading strategies, and it's one of the strategies I first started off with. I really recommend Fibonacci for new traders and for setting like take profits and setting stop losses and all of this stuff, because Fibonacci retracement, or this tool right here, literally gives you an entire trading strategy. It gives you an entry, it gives you an SL, and it gives you a TP. I'm going to explain how it does all of that stuff for you, but it just makes it super easy to trade. Personally, I don't use it as a complete trading strategy, but I use it as a confluence within the trading strategy that I'm teaching you. So it's just one of those where you can always do your regular price action analysis. You can read the chart, and then as you come to enter, you can whip out your Fibonacci, line it up, make sure everything's good to go, and then take the position. So cool. What actually is this? What does it mean? What do we use it for? So Fibonacci, or the Fibonacci retracement tool, allows you to draw out these lines at these levels, and these are all possible retracement zones. So the idea is that you need to identify a trending market. So you find the market that's in a nice trend. You can see right here, we're in an uptrend, pricing making higher highs and higher lows continuously. Now, we know from episode 2 that generally speaking, if we're looking at a nice trending market like this, when price retraces, we typically will retrace at least to the first previous point of structure. So usually, if you're drawing like a key level, you can always draw from the high like this, or if that level doesn't hold, you can draw from the low like this. That's standard like key levels. Now you can take it a step further and get really accurate with where you think price is going to retrace using the Fibonacci retracement tool. Now, the idea behind this is you get the Fib tool out, you draw from the low to the high. Again, keyword low to the high. You always drag from left to right. You can't drag from right to left. A lot of people make the mistake where they'll try like drag it backwards or whatever. This is going to completely confuse you. It's not accurate. It's not going to do anything. Always from left to right. Furthermore, if you're in a shorting market, in a bearish market, and you're using a Fib tool, equally, you're still dragging from left to right, but you drag from the high to the low, like this. Cool. So when you drag out your Fib retracement tool, it gives you all of these little levels, all of these little zones. Now, these are all custom levels. So by default on TradingView, your Fibonacci tool will look different. So what I'm going to get you to go ahead and do right here is open up your TradingView and copy down these Fibonacci levels. These are all unique Fib levels and they all serve a different purpose. I also have these color coded for a specific reason. So I can have my red zone, which I'm going to explain what that is. You have the golden zone and then your standard 50 and 3A zone. So again, just go ahead, copy this down, copy down the colors and the levels, and we'll continue past this point. By default on TradingView, the Fibonacci levels you get given are a little bit weird, so I wouldn't really be using them. But there's literally millions of Fibonacci levels out there. Furthermore, there's infinite Fibonacci levels because you can enter in literally any number and it will give you a level. Doesn't necessarily mean that level is going to be accurate or work for the pair that you're trading. These are specifically designed for the indices. Some of these levels do work on forex pairs. I'll explain the difference between that in a minute, but they're very specific for what we're doing.
Sweet. I'm going to take a photo and then do it afterwards.
That's cool. Yeah.
Just so I'm not sat here.
Yeah.
Or am I going to need it for what we're doing?
You'll be fine for now.
Okay, cool.
But yeah. All right. So these are the Fib levels. Cool. Now, just for the example of an uptrend, we've sat here, we've dragged our Fibonacci tool from left to right. It's now giving us all of these lines. What do these lines mean and what are we actually doing right here? Now, these are all various retracement levels. These are all percentage retracements. So just to keep it nice and simple, the 0.5 right here is a 50% retracement. That means this line right here, the price comes the whole way back. We've had a 50% retracement of this movement. So you see this movement identified? Had a 50% retracement down. Now, 50% is one of the most common retracements you'll find on any market. If you're going to have some sort of pullback and retest structure, chances are it will be at least 50%. So it's just a good like sort of zone to have in your head or to have identified, so you know, okay, cool. More than likely, again, it's not always 100%. We could definitely only retrace here or not even retrace the whole way, but more than likely, we're going to come back and retrace at least 0.5. Now you notice that in this scenario, conveniently, the 0.5 or the 50% retracement also lines up with our previous high. So cool. Now we have two reasons why we should be potentially buying at this level. We have the Fibonacci retracement tool telling us, okay, cool, this is at least a solid retracement. And we have previous structure and we have this key zone. So now we've got a couple of reasons that we should be looking to buy on this area.
Okay, that's cool.
Cool. So this is how you can start to stack up some of your confluences and look for multiple reasons to either buy or sell around the same sort of area. And that's essentially all trading is we're just looking for multiple reasons or multiple technicals to tell us to do the same thing at the same time. So once you have 4 or 5 things telling you, okay, buy now, maybe it's a good time to buy now, sort of vibe.
The higher probability.
Exactly, higher probability. So that's the most common retracement you'll find, the 0.5 or the 50% retracement. Past that, you have the 0.618. In trading this zone, so from 618 to 721, this is considered like the golden ratio. And again, it's got something to do with the maths. Mathematically, price is more than likely going to have the golden retracement or what. Some BS like this. Again, I don't quite agree with this level. To me, it's just another level. It's another retracement zone. And it's just here because why not? Is one of those. I'll show you when we put it onto a live market, when we actually put this onto the real TradingView price action, this level and this level is more here for a confirmation than it is an actual level you trade off of. What I mean by that is to confirm that your Fibonacci retracement is drawn in the correct zone. You want to see price reacting to these levels to like make you confident that it's actually there and you're not just looking at random lines. I'll explain what this means in a minute as we move on to that. But these are kind of just here for the show. Then past it, you can see right here, I have this red zone down here. So the 8.3 to the 0.78. This is the final line of like, yo, if we start to break these zones, more than likely we're breaking structure.
Okay.
That's sort of what this is. That's like the last line of defense sort of vibe. For Forex pairs, these are really good entry zones. If you're trading like GU, EU, EJ, any of the Forex pairs, these zones right here, these levels tend to give you the most accurate entries. Like, I don't want to call them sniper entries because again, all of that stuff is BS. But back when I did used to trade that, I used to get the most accurate zero drawdown entries based off of these zones because it's the deepest retracement price you're going to have. Chances are, if you retrace the whole way down here, there's not much further you can retrace without just completely violating and breaking structure. And what that does is it gives you a super high RR position. And what I was talking about earlier about the Fibonacci giving you an entire trading strategy is these lines are one of your entries. For example, let's say just hypothetically, I'm using the 0.786. I'm using this level as my entry. Price has come down, come into my level. It's giving me some reaction, some indication that, okay, we're slowing down. It's respecting this sort of zone. So I go ahead and enter right here. Now, because I'm trading the Fibonacci tool, I can use the fib levels to also draw my stop loss. So the idea is that if it's going to hold one of the higher Fibonacci levels, it shouldn't come down to a lower Fibonacci level because the higher one's held. So if I believe that this level is going to hold, I can put my stop loss below the 0.95 retracement level. Granted, on a structure basis, if we're talking about market structure, you should sort of always put your stop below structure. But the idea is that if you're trading this based off of the idea that this fib level is holding, we shouldn't even break past this one. If that makes sense.
Yeah, that makes sense. That's cool.
Yeah, so it can always give you a level where you want to put your stop loss because it does it for you. So it gives you an SL level, and then not only that, but it also gives you an area where you can put your take profit. Because the idea is that we've drawn from the zero up here or from the highest move. So we can always target, because again, the whole idea behind Fibonacci is you're in a trending market as well, and price wants to continue the trend. So you can always target the zero as your first take profit. So it's giving you a stop loss, it's giving you a take profit, and it's giving you an entry. So it's giving you the entire position. And then a step past that is you have these Fibonacci extension levels, the minus levels, the 0.23 and the 0.5. And these sort of anticipate for you where the next high is going to be. So in a trending market, price creates highs and lows. This is trying to show you where that next high is more than likely going to be at. So you can set this as like a further take profit level and a further extension level.
So you can have multiple take profits.
You can have multiple take profits. We're going to get into that on a further session about partial profits and all of this stuff. Generally speaking, I don't like to do it. If you're going to take profit, just take profit, take all of it. But if you were trading an approach where you were taking partials and like having multiple TPs, this would be a very good way to go about that. You'd have one here, have another one here, another one here, and maybe that one a little bit higher up. That is essentially the concept behind Fibonacci, is you're just determining how deep the retracement is going to be, where's price coming to, how can I use that information to benefit my position.
Cool. One thing that I wanted to ask, actually, just to kind of refresh my mind, maybe the people at home, it will help them as well. But you know how we draw our key level on the higher high, and then we put it on the next higher high, and then we predict that it's going to come back down and meet it. If it goes back down to the second higher high and then breaks through that, that's a role reversal, right? And then like the strategy that you're teaching me, you're out of the trade. Is that correct?
So what you were just saying right there is cool. You're in a trending market, you're in an uptrend. Your first key level is the previous high, which would be here. And then on the basis that price retraces deeper than that, we're then drawing from the low, which should be here. And then if price breaks this level, then we've had a break of structure, BOS, or a change of character. It then means that this previous support So this was meant to be support, meant to act as a bounce. But
Mm.
this previous support does become the role reversal level,
Okay.
and then it acts as resistance to be like this.
Okay.
That's the same thing. Again, just an easier way to kind of simplify all of this stuff in your head is just key levels. You're looking at a wall. What side of the wall are you on? If you're on this side, it's going to respect this side. If it's on the other side, it's going to respect the other side. That's it.
Yeah.
Cool. But yeah, the idea is that if prices had a change of character, it's broken your low, and you've had a market sentiment shift, you're not trading. You're out, dip out, take your capital, come back another day. There's no need to be trading in an uncertain market.
I just wanted to refresh my mind for when I'm doing back testing.
Cool, that's all good. But yeah, essentially, just to recap right here, Fibonacci also works in the other direction. Obviously, it works in the bearish market as well. You'd just be doing everything in opposite. So your fib retracement levels would be up top. You'd be looking to find a position like this, etc. And then you'd be looking to trade back down. Cool, let's continue. And let me show you how we actually use this in our live market. Before I go ahead and do that, let me quickly check price action because they're also around New York session.
Yeah, come. I wanted to ask, bro. So is US 30 like 30 companies inside of one stock? Is that what it is?
Exactly. Yeah. So US 30 is the top 30 US stocks. So it's like Boeing, MasterCard, American Express, like all of these combination stocks, Apple, Amazon, all of this. NAS 100 is the exact same thing, but it's the top 100 companies. So that's why these two price actions are very similar, because 30 of the companies in US 30 are also in NAS 100.
Okay,
so
that makes sense.
If 30 companies are bullish, the other 70 in NAS are probably also bullish, and then they have similar price.
Right, that makes sense.
Cool. All right, price is not looking too great today. It's not looking ideal. Looking at
what's the longest you've gone without trading for because you haven't seen like an optimal setup?
I've gone over a month.
Yeah.
Over 30 days. I would say like a month and a half, maybe, or maybe 2 months. But part of that was due to just taking a holiday, taking a trip. I would say like it's not uncommon. So especially if you're only trading one instrument and you have a very specific entry criteria, like you might go an extended period of time without trading. Like this is like 90 days worth of consolidation essentially. There's definitely trades within this. 100% there is trades within this. But it's just if you have a very specific criteria, if you need the higher time frame to be doing something and it's not doing that, and you don't want to trade, if it doesn't do that, then you might go a long period without trading.
Yeah, but it's better to like stick to your strategy in it rather than try like go the other way.
100%. But again, it comes down to this idea of, again, we're jumping ahead, but we might as well cover this. It comes back to this idea of discretionary. Why you go discretionary? All right. Do that one more time. And that seems a little bit more. Okay, that's just discretionary, just for anyone who discretionary versus mechanical trading. Have we spoken about this at all? I don't think we have.
No, unless it's like one of those ones where it's a term which describes the same thing, then no.
No, we haven't. Cool. So it all comes down to this concept of discretionary versus mechanical trading. Mechanical trading is having a trading plan, having a criteria, it's set yes or no, that if X, Y, and Z occurs, if I can see my key level and I can see the Fibonacci and I can see that the higher time frame is bullish, then I have to buy. And it's having like a binary yes or no system. You either trade or you don't trade. You have a very clear, this is a trade, this is not a trade criteria. That's mechanical trading. Now, a lot of people think mechanical trading is like the most profitable way to trade because like logically it's about following a system and having a plan and having rules and like making sure that you abide by that. But if that was the most profitable way for people to trade, then logically speaking, it would be more profitable to code that system into an AI or into an EA or some sort of bot and just have the bot trade for you. Because then the bot doesn't have emotions, the bot doesn't have to think, it would just follow your criteria and trade based off of that, and you would be winning and making money passively. The fact that manual trading is still around and the fact that it's more profitable than trading with bots shows you that it's not the case of having a set yes or no criteria, but it's actually something different, which then pulls back into discretionary trading. What is discretionary trading? Well, discretionary trading is having a methodology, having an approach to the market. So I only trade in trending markets. I only trade when price has a certain amount of volume. I only trade when at least these three criteria are met. But then past that point, you then have the complete authority to be like, okay, cool. I'm going to take this trade. I'm not going to take this trade. So essentially, you are the trading plan. Your previous experience in the market, the past years you spent looking at price, all contribute to your decision-making ability and your ability to either say this is a good trade or this is a bad trade. So it's all sort of ambiguous. And even though you have a plan, even though you have some sort of methodology that you generally follow, ultimately you can still make little decisions here and there. You can still kind of go against that if need be. But here's the key difference. You can't just be a retard and just be discretionary trading, but you're actually just breaking your trading plan. Like that's not how that works. The idea is that you have to sort of start off as a mechanical trader. You have to start off trading a system for a set period of time until you build up enough experience with that system, until you develop some more additional information in your subconscious brain. And then once you have, let's say, 1,000 trades taking a break and retest, you can then move on to discretionary, where you can use your experience of the 1,000 break and retests to find a setup that's not quite a break and retest, but it's almost there.
Yeah. There's a very fine line. It's like if you're gonna start trading discretionary, it's like you need to like trade discretionary. It's not like, oh yeah, I'm just like going off here, going off here, going off here, going off here. Then it's not.
It is a very, very fine line, and it's almost a confusing concept in a certain sense, because again, a lot of people have this idea that your trading has to be super mechanical and like it needs to be super systemized, and that is the approach. I do agree, especially for like every newbie trader watching this. You need a system, you need a set criteria, you need something telling you when do I trade, when do I not trade. You should not be trading discretionary because you're going to confuse yourself. Furthermore, if you start off as a discretionary trader and then you try and journal your trades, it's going to be incredibly difficult because you're not going to understand, why did I lose? Was it me? Was it the system? Was it my analysis? Did I just take a bad trade? Like, it's difficult for you to identify what you've done wrong. When it's mechanical trading, it's very easy because you can look, was the trade valid? Yes or no? Yes. Okay, cool. Why did I lose? Was it my psychology? Did I do something dumb? It's easier for you to identify where you went wrong. Furthermore, there's actually a great book on this called Blink by Malcolm Gladwell. I don't know if I'll probably mention this tons of times on YouTube in it, but it's called The Power of Thinking Without Thinking. The book's all about the subconscious brain, and it delves into this topic very, very deeply. It's not even a trading book. It's actually just a book in general, but it highly, highly correlates to this topic right here. And again, it's all about building the subconscious brain, building that ability to recognize certain patterns and recognize trades and stuff. And furthermore, all of this stuff comes from your backtesting primarily. You can achieve this in a live market over a long extended period, but it's going to primarily come from your backtesting. If you sit there on FX replay every day for a couple of hours a day, and you do like 50 to 100 trades or whatever, and over the course of a year, you've taken 10,000 positions using the same methodology. There might not be identical trades, but you've taken 10,000 positions using a break and retest system. Throughout those 10,000 positions, at some point, you're going to find a couple of trades or whatever that almost look good. And you're like, yo, this might be a trade, but then it doesn't give you that last criteria and it still plays out. And then your brain's going to remember that and you're going to see it time and time and time and time and time again. And the idea behind discretionary trading is at some point, you're like, yo, I've seen this 700 times where it gives me this exact movement, but it doesn't give me this last criteria. I know it's about to do this movement. I'm going to take the trade anyway.
Right. No, you broke it down perfectly there.
Exactly. And then you take the trade and then you add it to your arsenal of like, okay, I can also take this position. Right. And you start to like build the building blocks of.
Yeah. So it's like, I don't want to overcomplicate it, but I'm kind of just saying it for myself here, is that mechanical, right, is following a plan.
Yep.
And then discretionary is adding little bits to the plan, but you need to like learn what bits to add. Does that make sense?
Yeah. That's definitely a way you can think about it. Pretty much, bro. And then at some point, once you've been adding little bits to the plan for like a long duration of time, eventually your plan is differed so much from the original mechanical plan. Like, it's still based off of the same, like it still came from the same thing, but it's so different that it's not even the same strategy anymore because you just trade differently. But it's still based off of that, and it's based off of that slow progression that you've gotten to.
100%. But I can see that it's a very fine line. It's like you need to actually go through the process to add it, rather than just like, oh, that worked a few times, I add it. You know what I mean?
Exactly.
Yeah,
And again,
because I've already, sorry to interject, I've already seen, like, just from the small back testing that I've done, there's like a lot of little discretionary things that I've seen. However, I haven't done enough data collection to make sure that they are actually discretionary. I don't know if I could have said that correctly, but yeah.
100%. 100%.
Yeah, cool. Oh, I'm happy that we covered that. It's good.
Nice one. Cool. Let's continue. Just looking at you. Cool. What was the original question? I feel like we went on a tangent there.
No, we did. We traced on that. My original question was, so we discussed Fibonacci, and then Fibonacci, and then we discussed. We went through key. Oh yeah. My original question was, yeah, I interjected and I said, what? Yeah, I asked about the key levels shorting, and then from there, well, no, when not shorting, when I wanted you to clarify what a role reversal looks like, and then from there you said we're jumping ahead a little bit, and then you went down to discretionary versus thingy.
Oh, I see. Cool. Say no more. We'll move past that.
Cool.
Just to give you an example of fib, just swinging back around to fib. You need to be in a trending market. Price needs to be creating highs and lows, and you need to be able to see the highs and lows. So fib is meant to be used in a very specific type of market. The reason that I don't use this as my primary trading system is because we mostly trade the indices, US 30, NAS, German 30, and the indices tend to have price action a lot of the time that looks like this, where it prints these big movements, gives you very small retracements, and it doesn't give you the opportunity to find a secondary entry. So the reason that fib doesn't work too well on a market like this is because, cool, you draw out your fib, you wait for the retracement, you never get the retracement, and it just pushes off. So it's not ideal for a market that's like super high volume or whatever. It's not great. It's much better for the slower moving instruments that have deeper retracements. And furthermore, again, going on a bit of a tangent here, but every instrument, when I say instrument, it's what you're trading. So every pair, every stock, every whatever it is that you're trading has its own set of characteristics. It's like a personality. Everything you're trading has its own personality. And the different strategies and the different systems are going to work better with different personalities and different characteristics. So they might all work across the board. Fibonacci will work on any market. You can apply it to anything, but it's just going to have a better success rate and whatever on certain instruments. Those instruments are the ones that tend to have deeper retracements and have more frequent pullbacks. So markets that look much more like this. Now, for me personally, this is a very annoying market. I don't want to trade this, especially for the strategy that I'm teaching you to trade. It's annoying because you're just having price come back and forth every couple of minutes or whatever, and it just takes longer to move where it's trying to move. But for someone trading a retracement strategy, you need the retracements to give you entries and to give you opportunities. And this might be a beautiful market. You might be able to catch 4 or 5 trades on the way up while I catch 1 trade because we're just looking at price differently, if you see where I'm coming from. And again, this all links in. We're going on a bit of a mad one here, but this all links into your psychology and how you want to be as a trader, or what you want to be like as a trader. Some people want to be sitting there every day, taking multiple positions, looking at frequent retracements and all of this. Some people just want 1 position in and out for the week, they're done. It just depends on what you want to genuinely achieve from your trading and how you want your day-to-day trading to look like. And that's why I highly recommend, as a new trader, if you don't know what your ideal trading day looks like, try out a couple of different systems, try out a couple of different approaches to the market and see what meshes well with your psychology, see what you enjoy trading. Because ultimately, and this is something a lot of people don't speak about, but if you're sitting there every day trading for years on end, you want it to be something you enjoy doing to a certain level. Granted, candlesticks are always going to be candlesticks, never going to be having the greatest time of your life, but have a system that you actually enjoy trading because you're going to be doing it every day and it just makes it easier. Cool. Good. That's the fib levels. So in an ideal world, you're looking for a market that looks something like this. You can see we're trending, but not super high volume. We're not just leaving the big moves like this. We're pushing, we're pulling, pushing, pulling, Like we have these push and exhaustion phases, and we're leaving some sort of structure. So right here, I am cherry picking. I'm obviously picking a good example so I can show you, and it's not always going to work like this, but just for the argument's sake, you identify a movement. This is the this is the London low. So this is the London session right here at 8 a.m. and we just left this little wick down here. So this is pretty safe to say this is the low of the move. It's the lowest low we can see. So I'll go ahead and draw out my fib and go from the low. And again, the point is the wick low, not the body. A lot of people make a mistake. They go from body to body. It's wick. So you go from this wick low and you drag up to the high of the move, which is this high, not this high, because that's the previous move is this high. And you drag and you extend right so you can actually see your lines. See, from the low to the high, that is my Fibonacci retracement. And the idea is, or just to put it back in replay mode, the idea is you now sit here, or furthermore, just to put it even further back than this, because I kind of missed a step, you generally be drawing these markets in one of two scenarios. Sorry, you generally be drawing these levels in one of two scenarios. Scenario A is when price has first created a new high. So cool, you found this market, price is bullish, you're looking for a buy, it's at a higher point right now. You're like, okay, I don't want to enter at the high because you're probably going to come down first before we go higher. So then you draw out your fib level and then you wait. That is obviously a lot longer, depending on what market you're on. You might be sitting there waiting for hours for something to happen, and that's not ideal. Or the second alternative is price is already mid retracement and you can identify, yo, we're currently in the process of a retracement. I can now draw my fib levels, and at some point around this sort of general region, I can take a trade. So you're doing the same thing, but one is just identifying it before the matter, and one's identifying it while it's actively happening. When you identify it when it's actively happening, obviously you will take a trade quicker because price has already happened or it's happening. But it might, and again, it's more psychology, but you might be more eager, more excited to take a position right now. You might enter off of an earlier level because it's kind of happening and you want to trade, and like kind of links it more to the psychology. So for psychology purposes, you would be better off drawing it in advance and then waiting, but just in general, it's the same difference. Cool. So you draw your zone and you wait for price to come and have a retracement. Now I know probably a lot of you guys at home are asking, how do I know what level is going to hold? What level am I trading off of? Is it this one? Is it this one? Is it this one? You could arguably trade off of all of them, and they are all valid levels. But that's why you want to start to stack your confluences. And what I mean by that is you want to find another reason to buy or sell at that level. So if the Fibonacci was not here, where would you be looking to trade off of in this example? And I'm asking you, Sam.
The white wick to the left.
The white wick to the left here.
Yeah.
The low. Cool. And what would you do at the low?
You would pull left to right. No. Yeah.
Yeah. Pull left to right. Cool. Like this. So this would be a level to buy off of. Why would this be a level to buy off of?
Because it's hitting the previous low, or it's going into your key level.
Yeah. Cool. Nice. So now if I also stack and add the Fibonacci retracements, what level lines up with this?
I can't actually see on the screen. I guess it's the
786.
Yeah.
Cool. Now, out of all the fib levels you can see right now, what's the most likely level to respect? Just based on speculation, do you think?
7.8.
Well, and why is that?
Or actually, no, the one above.
What, 721?
Yeah.
Why is that?
Because from what you explained earlier, usually if it dips down, oh, actually, no, it's gonna be the lowest one, because that's where the previous low was.
Yeah.
Cool.
Yeah, cool. Solid. Almost had it then. All right. And the idea is that we have two confluences right here telling us to buy. So it's just a slightly higher probability. And again, nothing's guaranteed in the markets. Just because you have a bunch of lines on your screen doesn't mean anything. So it's still a probability. But the idea is that this has the highest probability out of the levels of respecting, because there's another reason to also respect right here, and that's the original low. So now what we do with this information is we don't immediately start placing buys and just start trading based off of this information, because that would be speculation, and we don't do that. but you'd be waiting for a retracement into your zone.
Mm.
And then once you've seen a reaction away from your zone, so you see right here, we come in, we rejected, came back in, rejected, printed bullish candles. Once you've seen a reaction based off of that, you can then make a decision to take a trade, have your stop loss in a reasonable space. So I'll just have it at the wick low, at the 1, set a nice take profit, and then play out your trade. And that is essentially the idea behind it. Granted, right here, we didn't go through entry confirmations. We didn't go through like looking on a lower time frame. But the idea is that once price is tapped into a level, it's giving you a reaction, you can then scale in to a smaller time frame and start to look for a number of confluences. You can start to look at behavior, because you can start to look at a little 5-minute market structure shift. You see right here, it creates a little low, a lower low, and then breaks that with the high, quite a high volume candle. So that can be an indication to get the buy right there. There's a lot of things you can do on a smaller time frame to really like zoom in and understand, cool, is it now? Do I take a trade now? Do I wait, etc.? And those are factors we're going to be covering in the next session. We're going to be looking at depletion. We're going to be looking at behavior. We're going to be looking at the liquidity grabs a little bit, maybe some smart money concepts here and there. But that is the idea behind Fibonacci in it. Now I'm slowly going to wrap up this session right here because we're kind of extending it a little bit. I want to clarify for you, Sam, and some of the people at home. The way that I personally use Fib is not as the main strategy. I'm not sitting there actively drawing Fibonacci retracements or like looking to use that as my SO or my TP or whatever. For me, it's more just a confirmation. I'm always looking at market structure. I'm always looking at the high or the low. I'll draw my key level in anyway. And just sometimes while I'm sitting there waiting for price to retrace, I'll whip out my Fibonacci. Where's the most likely place for us to retrace? Oh, it's at my zone. Makes sense. Delete it. And I'm back to waiting. Sort of vibe. Or equally, just if you're trying to get a better idea of price and you can just see a big movement and you just want to have an idea of where are we more than likely going to come down to, it can give you an idea to where that's going to happen.
It can be comforting to have on the screen.
Yeah, for sure. And again, a lot of people like the mathematical side of it in terms of like there's a lot of maths that goes into this. This is one of the most proven strategies. There's a lot that goes into Fibonacci, but for me, I just use it as a little complement just to give me a better idea here and there. But some people absolutely love it. So that's why I'd recommend, if you do think that your style is more, you want to have something on the screen telling you when to do certain things, maybe Fib is the way forward for you. So I'd recommend sit there and backtest it and have a little play around. Not only that, but have a little play around with which levels react and what instruments they react to and what time frames and stuff like that. Cool. Now, between now and next lesson, Sam, what I want you to do is I want you to continue doing the backtesting you were previously doing in terms of market structure, finding a high, finding a low, higher time frame stuff. But also, I want you to take 5 trades based off of an additional Fibonacci confluence.
Okay. So
5 trades where you find your market structure, all of that stuff, and then it also happens to line up with a Fib, and you trade it based off of the Fib as well.
Okay, cool. I assume it's the same. Sorry to interject. I assume it's the same on FX Replay with the Fib.
Yeah, exact same process. It's all the exact same. But that's it. Get some back testing in there, and then on the next session, we're going to continue to look at some stuff on the lower time frame. We're going to look at entries. We're going to really go through stop losses, what they are, what they mean, why it's super important to always have one. Going to look at take profit placement, liquidity, some smart money stuff. I'm going to start to piece together the strategy and give you an actual trading plan to properly be following.
Great.
Yes, sir. All right. That's it for episode 3, day 3 of the boot camp, guys. Hope you guys enjoyed. If you made it this far in the video, thank you for watching.
Yeah, fucking back testing, lads.
Let's get to the back testing. And yeah, see you guys on day 4, innit? Feel free to click this up and make some TikTok edits and that too.
Yeah.
All right, cool. Where's the meeting recording? There we go. Start recording.